Hi everyone. Good morning. Can everyone see my slides?
We can see them.
Okay, great. So my name is Wendong Zhang. I'm a new assistant professor in the economics department at Iowa State. And today I'm going to talk about the farmland market in the US. Before I start the slides, I want to echo the comments by the two other panelists that the farmland actually accounts for 900 million acres, and it's valued at $2.4 trillion nowadays, and consistently accounting for 84% of the U.S. farm assets if you look at the U.S. ag sector as a whole. And from the single producer perspective, is often the largest investment item from the landowner's perspective. So it's very significant. And today, I'm going to mainly talking about what is the current situation and what's ahead for the farmland values in the U.S. And the guiding framework I will be using is the recording framework. You can simply think about the land market as driven by two things: income and interest rate. So when income is higher, land values tend to be higher. When interest rate is higher, then you have downward pressure on farmland markets. And another thing, as mentioned by the two previous panelists, that the source of income could be different. So if you think about Rhode Island farmland values, you're talking about income from urban influence and natural amenities. But in corn belts, like where I'm at in Iowa, it's mainly from crop protection. So that tends to be localized, while the interest rate tends to be universal. When we are looking at the farmland values, it's useful to look at the market from a historical perspective. Currently, we're in a downturn or a financial stress period. Now it's kind of a way of whether you can judge whether you are half empty or half full guy. From a pessimistic perspective, Iowa farmland values have been declining for the first time 3 years in a row since 1980 farm crisis. However, if we look at the reduction of the land values, the magnitude is much lower compared to the 1980 farm crisis. And one of the takeaways I want to deliver through the presentation is when we are looking at putting this current downturn into the historical lens in comparison, especially with the 1980 farm crisis and the 1920 farm crisis and the Great Depressions, I'm going to argue that we probably, for the whole sector, we are not going to see another replay of the collapse of the market as we see in the 1980 farm crisis. Otherwise, rather we probably will see a modest adjustment to a more normal return. So if I go back, we think about what happened in the 2000s, they're driven by historically low interest rate, phenomenal export demands from emerging markets like China, and also a new source of use for corn coming from ethanol. So you see dramatic increase in farm income and farm assets values since 2003 to 2013, and that's arguably in the long history of agriculture in the U.S. and in the world, it seems to be a more abnormal high return period rather than the normal period. So, however, as Dan mentioned, that from the individual producer perspective, they tend to face greater volatility. And although the whole sector, I don't think there's a high likelihood of replay of the 1980 farm crisis, there are disproportionately affected producers, especially for the younger ones who tends to have larger debts. And we do see signs in deteriorating farm income. So the net farm income in the U.S. have been cut in half compared to the peak in 13, and you do see a growing delinquency rates on farmland loans and other working capital loans, and we are also facing some uncertainty in terms of exports and deteriorating livestock returns as well. But I do think there are at least four positive reasons why we're not likely to see another farm crisis. I will go over them individually. The first one, I think the fairly biggest one is it is natural for us to focus on the current period and look at the current downturn, but it's also important to look at what happened before we enter the farm crisis or the current downturn. So if we think about in 1980s, before that, in the 1970s, a lot of people think they have the dramatic increase in income and asset values. However, those are mainly driven by the hyperinflation. So Neil Howe, Professor Emeritus from Iowa State, used to call this the gains are illusionary. And if we think about the current income gains, on the income inflation adjusted basis, there's 8% growth every year from the U.S. perspective. So a lot of producers have accumulated significant assets to deal with the potential downturn. Hopefully, we have seen the worst declines are already behind our back. So another positive is the Kevin and Dan has already alluded to is despite recent hikes by the Federal Reserve, we're still in a fairly low interest rates. So we're probably moving from historically low interest rate environment to a fairly favorable low interest rate environment. Although there is a significant uncertainty of how quickly and how big the magnitude of the Federal Reserve will make that adjustment. So remember the formula, land value equals to income divided by interest rate. If interest rates rise sharply, then that could potentially have a big impact on asset values. The third point is through the 2007-2008 farm financial crisis, there are a lot of more stringent regulations which in fact helped limit the amount of the leverage in the sector, in the sense that there's less ability for the individual lenders to make large loans. If you think about the 1980s, the ag lenders could potentially make loans to a loan-to-value ratio to even 85%. Now that ratio is less than half. And how you are calculating the collateral value is typically based on cash flow. So you're assuming $4 corn prices, even the prices was $6, $7. And now, rather than using the inflation-adjusted prices. Another positive thing is hopefully this time we have a stronger and larger, better covered government safety net. If we think about from one perspective, the crop insurance coverage in the 1980s only covered less than half of crop acres in Iowa. Now it's over 90% for both corn and soybean. So based on these four reasons, I don't think sector-wise we're seeing a replay of the 1980 farm crisis. But however, this doesn't mean that we don't see individual producers or a growing group concerns in the agricultural community. And in fact, we already see signs of that. So looking ahead, I think we're seeing the worst adjustment of the farm income has already been behind us. We probably will expect to see a further decline in farm income and consequently a modest decline in farm asset value as well. And here are some of the recent numbers. In the top line circled in red is from Chicago Fed survey, which reported there's no change in there's very little change in the Corn Belt's farmland values. So it seems there are signs of modest decline, or potentially in the near future there will be stabilization of the markets in the Corn Belt. However, if you look at the Kansas City Fed figures for the northern plains, you see larger declines in the asset values. So I think in the future we probably will see a continued downward adjustment in the land markets, which is consistent with the producer's expectations on the market. So Purdue University is working with CME to unveiled one of the ag economy barometer, which asks a nationally representative producer sample of over 5,000 producers, how do you think the farmland value prices will change in your area? And the longer bar you see is the share of the people who think there's a lower, they're more likely to see lower farmland prices in their area. So you see the general sentiment is we still expect to see downward adjustment in the land markets, but in Iowa, there was one survey by Realtor Land Institute, ag professional organization consisting farm managers and appraisers. They already, their survey showing that Iowa farmland values have inched up 1% since the last 6 months. So I think there are probably more stabilization in the corn belts. Maybe there's a greater decline in the northern plains, and in reflection of deteriorating livestock returns. And if you think about back in the days that the CRP payments helped boosting the pasture land values in those areas 2-3 years ago as well, but now that has gone down with the drop in commodity prices as well. So again, the guiding framework is the recording framework. How should you think about the farmland markets? You should think about what will happen with the income, what will happen with interest rate. Interest rate is likely to rise, which puts additional downward pressure on the market. And the net farm income, according to USDA forecast, we probably will still see a downward adjustment in net farm income in this year and possibly next year as well. But hopefully before 2019, 2020, we see a turn in the income and the asset prices. In terms of the future, there are several key things to watch. The Ag Secretary, Sonny Perdue, just got confirmed this Monday, and today I think the administration just unveiled one of the tax reform. We'll hear more details this afternoon. And the Federal Reserve, if they dramatically change the interest rates, then we will see the market reactions. However, I don't think they will. A more likely scenario is they will adjust upwards the interest rate. However, they probably will adjust in a slower pace, which will allow the market participants to adjust. So we probably will see an increase in interest rate over the next 3-4 years. Another uncertainty is possible trade tensions and renegotiations with key partners, including China and Mexico. And we hear in the news that Mexico is threatening to play the corn card of reducing or cutting corn imports if there are other NAFTA in a NAFTA and other negotiations with the new administration. And regarding the Farm Bill, I don't think we have enough information to tell concretely how that will affect the information. However, we already know there is a proposed 21% decline for the budget for USDA. And regarding the Farm Bill, I think everyone is trying to read the tea leaves, but we don't have a lot of information to read on. There is very interesting. I'm watching closely how the tax reform might affect agriculture. One of the examples is there's in the estate tax reforms, there's one thing called the step-up basis. Currently, if you delay your farmland sale till death, you can adjust the original purchase price to the new basis to the current prices, so you don't have to pay capital gain taxes, which limits the farmland supply, which help bolster the farmland values. If that got eliminated, that could cause reactions in the markets as well. So with that, and in the end, I want to alert one of the interactive web portal I developed where it's fairly easy to remember. So CARD stands for Center for Agricultural Rural Development, CARD Farmland, and on which you not only can see Iowa farmland values, but also you can compare across the states, especially for the Corn Belt and the Midwest, to see where the growth of the markets are and spatial distribution. I encourage you to check it out. Thank you very much, and you can find the slides online in my website as well.